Hello friends, CA Conjugal this side. First of all, I would like to thank you, CA Sansaar and Mr. Vivek Khurana, founder of CA Sansaar, for giving me this opportunity. Myself, CA Conjugal, I am a CACS registered valuer with ICAI, having more than 10 years of experience in taxation, financial advisory, tax planning, negotiation, and a structure with industry. So my today's topic of presentation is basics of mutual fund. Here is the flow of the presentation. First of all, we are going to understand the basic terms of mutual fund industry. Then we are going to understand what is a mutual fund, what is the structure of the mutual fund, what is an asset management company is, how does mutual fund work, what are the myths prevailing about mutual funds, and why to invest in mutual funds. And then we are going to see for our education purpose that how the benchmarks of mutual funds are beating the other investment options. Then we are going to understand the basis of classification of mutual funds. We will be having detailed presentation on this later on. Then how we can invest in mutual funds. Let's begin. Basic terms of mutual funds. So first term is SEBI. SEBI is the Securities Exchange Board of India. It is the regulator of securities market in India, and it regulates mutual fund industry as well. Mutual funds is a common pool of investment wherein investors sum together and they pour money in a specified scheme to attain the objective of the scheme, and they get benefit from the capital appreciation or dividends from the scheme. Then unit is the smallest denomination which denotes to the beneficial interest of the investor. It is just like a share in the company. Asset management company. Asset management company is the company regulated by SEBI, which does the job of managing the assets of the trust. Because trust itself cannot manage the assets, so there is an asset management company which manages assets of the trust. Then net asset value per unit, as the name suggests itself, net asset value per unit denotes to the net assets minus total liabilities divided by total number of outstanding units is net asset value per unit, and the investors that benefited when the NAV per unit rises, or they suffer the losses if the NAV per unit diminishes. SIP, as the name suggests, SIP is systematic investment plan. It refers to the investment plan wherein the investor invests in mutual fund scheme on systematically on regular intervals. Systematic withdrawal plans, SWPs. This is reciprocal to the SIP. In this kind of plan, an investor invests large sum of money in a particular investment, and he withdraws the amount from this to on regular intervals to attain different objectives. For example, if a person is willing to invest in equity mutual funds, then he may choose to invest 10 lakh rupees in liquid funds. Then he can start investing in equity mutual funds with 1 lakh rupees per month, and same way 1 lakh rupees per month SWP will be initiated in liquid funds. Fact sheet is a basic 1 to 2 page document. It contains important information about fund, like what are the holdings of mutual fund, what is the asset loss, what is the past performance of the mutual fund, who is the investment manager, etc. Investment manager is the natural person who manages the assets of the company, because AMC itself cannot manage any assets, so he needs people, natural persons who are going to manage the assets, who is going to do the job for the AMC. So investment manager. SID is the detailed document which contains various information about the scheme, like risks associated with the scheme and how the scheme is going to attain its objective, what are the threats prevailing, why it cannot achieve the expected return, or how it can perform better than the market. in the upcoming days. Riskometer defines the risks associated with the investment in accordance with guidelines issued by CB. Exit load is a kind of penalty which is charged by the mutual fund scheme or AMC for early redemption than the prescribed holding period. Now we come to the slide. What is a mutual fund? So mutual fund is a common pool wherein funds are contributed by investors to attain the objective of the scheme, and they are allotted units against their investments, which denotes to their beneficial interest in the scheme or the trust. There are trustees. They oversee the management by the investment managers. Now all these are summarized in this sheet. Basically, here is the sponsor, and the sponsor enters into a trust deed with the trustees. They form the trust. That trust is known as mutual fund. This trust collects money from the investors and give money to the asset management company, which is responsible for managing the assets of the trust and generating the return for the trust, whose ultimate owners are investors. And this asset management company avails various facilities or services from other companies like registrar and transfer agency for updating the KYC documents of the investors or giving the investors dividends, etc. Then bankers are there for wherein AMC keeps the money of the investors, and there are agents or distributors which ultimately seal the or do the marketing for the asset management company. So this is the overall structure of the mutual fund. Now, what is an asset management company? And an asset management company is the investment manager of the mutual fund. This is appointed by SEBI. This is appointed by the trustees, with SEBI approval. And trustees and AMC enter into an investment management agreement wherein they agree to get the fee and fix the responsibilities of the AMC. So this is a very crucial task, and SEBI has put few restrictions or guidelines for the AMCs to be required to be followed by them. First of all, they need to invest 1% of amount raised subject to a maximum limit of 50 lakh in all open-ended schemes. So AMCs have to put their money in the scheme so that they have their skin in the game and they have the interest. AMC should have at least 50 crores of net worth at all times so that they make sure that they have the sound financials and investors' money are not at stake. And for corporate governance aspect as well, the SEBI has put a restriction that 50% of the members of the AMC has to be independent directors only, so that there is good corporate governance there. Then AMC of one mutual fund cannot be the AMC or trustee of another mutual fund or another fund. For example, SBI AMC cannot be the AMC for HDFC, or HDFC cannot be the AMC for the Aditya Birla or something like that. AMCs cannot engage in any other business than financial advisory, which is again a restriction for good corporate governance, because AMCs are required to be focused and they need to take care of the people's money prima facie. So now we have understood what is the structure of the mutual fund and what is mutual fund. This slide represents to the overall functioning of the mutual funds. Here are the investors. They come together, they come mutually, they pool their money, then they give money to the fund manager or AMC and oblique investment manager. This fund manager is going to invest the amount in underlying assets like stocks, debentures, corporate bonds, gold, etc., which is going to generate the return, and this return belongs to the investors. As you can see that people are coming together and they are getting their mutual benefits, so that's why this is called mutual fund. Now we come to the very important part of the presentation. What are the myths prevailing about the mutual funds? So first and foremost myth is mutual funds are for long-term purpose only. People think to invest in mutual fund you should have long-term horizon only. This is not true. As I have mentioned in the slide, that there are various categories of funds. Even if you want to pour your money for 30 days, you can choose liquid funds. If you want to pour your money for 60 to 90 days, you can choose ultra short-term debt funds, etc. So this is not true. Mutual funds can be for short-term period as well. Then second prevailing myth is mutual funds having lower NAV are better. People think that a mutual fund unit which is trading at 10 rupee or which is having face value of 10 rupee or market value of 10 rupee is good as compared to the mutual fund unit having market value of 20 rupees. This is not true. We have already understood that NAV denotes to the total assets minus total liabilities divided by the total number of outstanding units. So the NAV, the mutual fund listing which is having lower NAV must be having lower assets or higher liabilities. Hence the NAV is lower. So this is not true. The return depends upon the return generated by the underlying assets only. Then mutual fund companies only invest in equity market. Many people think like it. No, mutual fund have various categories. Like I would like to show you from my slide that these are the categories wherein mutual fund can be invested, like equity funds, debt funds, hybrid funds, solution-oriented funds, or other funds. So mutual funds can be having equity funds or debt fund depending upon your choice. Then people, again, the fourth one is a mistake rather than a myth, that people think that best performing schemes are better and they choose to invest. This is not true. See, every mutual fund document contains the line that past performance may or may not be sustained in future. This is not an statutory line only. This is reality. And we all should consider it before investing or before starting our investment in mutual funds. Because pharma sector has performed very well in 2020, but it was underperforming the indices as compared to the past. Then again, next risk or myth about the mutual funds is market is very high or risk is very high. I will start investing when the situation turn around. So you should never think like this, and you should invest in mutual funds or for your investment objectives, for your retirement plan on regular intervals. The next myth which is prevailing in the market is they just invest once and forget. कि आपने आज invest कर दिया, आप उसको भूल जाओ. You are going to get the return. This is not true. You should review your investments on periodic intervals. This myth, the last myth, is more prevailing in tier 2 or tier 3 cities, that mutual funds are risky because it is not regulated by the government. We have already understood that CB, who is the market regulator, governs the mutual funds, and it is very well regulated. Then why we should invest in mutual funds? So as apparent from this slide, that fund manager is there and he is a professional manager, so you are going to get the advantage of professional management. Okay, the professional management provides you, the person who is managing the fund is having lot of experience, and his job is to manage the securities only day in day out. So you get the advantage of professional management at very cheap prices. So this is the very big advantage available with mutual funds. Then liquidity. If liquidity is one thing which is very good advantage for mutual funds, if a person has invested 5 lakh rupees and he is having requirement of 1 lakh rupees, then he can redeem the investment to the extent of 1 lakh rupees, which is not available in other investment avenues like FDs, insurance policies, PF, etc. And this money is credited in a day or two. So this liquidity, there is no problem in of liquidity in mutual funds. Diversification. It is well said by various investors, even by Warren Buffett, that you should not put all your eggs in one basket. So diversification is the key for which one should consider to invest in mutual funds, because mutual funds invest in at least 20 to 50 SRIPs, limiting the exposure in a single company. Then cost effectiveness. SEBI has put a cap on the amount of expenses to be charged by AMC to the mutual fund scheme, which is very much lower than as compared to other investment avenues like NPS or PPF or insurance policies, etc. Beating the inflation. As we know, the inflation is at 6% and the interest on deposit is 5%. We are in negative interest rate right now. So we need to grow our money at a faster pace than the inflation to be rich or to meet the inflation. Mutual funds very well provide us this facility, which is evident from this slide, that if you see it, that Nifty 50 benchmark, I have just compared benchmarks only. I'm not recommending any mutual fund is seeing here. This is just for education purpose, and I have analyzed the returns of the benchmark indices only. So Nifty 50 return is, we just ignore one first year return, 1 year return on SIPs. We look at 3-year returns, 5-year return, and 10-year return, and we can easily draw the conclusion this is much higher than the rate prevailing, interest rate prevailing in other investment avenues like PPF, Sukanya Samriddhi, etc. Another advantage with mutual funds is an investor can invest in mutual funds with 500 rupee per month SIP. So it is for all. Taxation, mutual fund taxation is very much lower as compared to other investment avenues like tax saving FDRs, etc. And we will discuss it in later stage. Transparency and strong regulations. Mutual funds are well governed by SEBI, so it has very much transparency. Very low lock-in period. In ATC says we all invest or we all save money to save taxes for under section ATC, and the mutual funds, particularly ELSS, is having least lock-in period of 3 years, while tax saving FDRs and other investment avenues are at least for 5 to 15 years. This slide is already covered. It shows the past returns of SIPs, and we can easily draw the conclusion that returns provided by debt funds as well as equity mutual funds is much higher than the current prevailing interest rates. So one should consider to invest, and they should consider to invest in mutual funds. Then here we come to the classification of mutual funds. So basically I have made classification of mutual funds on 3 bases, based on their structure, on their investment objective, and investment style. Based on investment structure, there are 3 categories: open-ended fund, closed-ended fund, interval funds. Based on investment in objective, there are 5 categories of mutual fund: equity funds, debt funds, hybrid, solution oriented, other funds. And these categories are defined in the SEBI circular dated 6th October 2017, which is given in the description. Then and open-ended funds are the most prevailing, and AMC is launching open-ended funds only. These funds provide you liquidity and everything, and these are tradable on recognized stock exchanges as well. AMCs allow you to purchase these funds on daily basis and redeem their funds on daily basis. Close-ended funded are reciprocal to open-ended fundeds. They are run for a specified period, and AMC generally accept the subscription for particular days, for particular period, and they just close accepting the amount of investment, and they allow you to redeem your investment only after the specified period is passed. Then there are interval funds. These are hybrid of open-ended and close-ended, and they just allow you to redeem your investment on periodic intervals, just like 1 year, 6 months, or something like that. Classification based on investment style. Passive funds. Passive funds are just passive funds are not managed actively, and they just replicate a market index. For example, if you are willing to invest in HDFC Nifty Index 50 fund, then the mutual fund will be having the same as stocks which are contained by Nifty 50, which is the benchmark, like I have mentioned on this slide. So passive funds are going to replicate the portfolio as of the index, and they will have the lower expense ratio, and they will provide you the same kind of return which is going to be provided by the index itself. Then there are active funds. Active funds are, as the name suggests, these are actively managed by the investment managers, and investment managers change the asset allocation or the securities allocation as per their own judgment. For example, if a fund manager is managing any active fund, any large cap active fund, so considering the situation, he may be willing to invest more in IT or pharma in the COVID pandemic, and their return varies from the index. It may be higher or it may be lower than the index, and because it is actively managed and the time of the management investment manager is involved more in this category of funds, these are having higher cost as compared to passive funds. In the categorization of mutual funds based on investment objectives, there are 5 categories: equity schemes, debt schemes, hybrid schemes, solution-oriented schemes, and other schemes. Equity schemes, as the name suggests, they invest in equity instruments prima facie, and they have large exposure towards in equity only. Debt schemes contain the invest in debt securities, and they have exposure in corporate bonds, government securities, etc. Hybrid is the mix of equity and debt, and the investment manager invest in equity instruments and debt instruments simultaneously. These are solution-oriented schemes. Solution-oriented scheme, if a person is willing to invest in, if a person is willing to invest for his retirement, then he may consider to invest in solution-oriented scheme. Or if a person is willing to invest for his child education, then the solution-oriented scheme. And other schemes like index fund or gold investment, or etc. This is a very important topic, and there are 33 categories of mutual funds, which can not be explained here in detail. So I will be presenting, and we will be discussing these schemes later on in upcoming videos. Then how we can invest in mutual funds. So as we are aware, there are various means through which we can invest in mutual funds. First of all, there is website portal of mutual funds like HDFC, SBI. You can directly go to the portal of the mutual fund, and you can directly invest in the mutual fund. Then there are mobile apps of the mutual funds, like every mutual fund company is promoting their mobile apps, SBI Yono app or HDFC AMC app, something like that. You can choose. Then we can invest in mutual funds through our demat accounts as well, through which Then banks or distributors, banks or AMFI registered distributors also assist you to provide to invest in mutual funds. And there are various apps which have been recently developed in 5 to 10 years, like Grow app, ET Money, moneycontrol.com, etc. So that's all. Thank you. If you have any questions or queries, you can just comment. And this is my personal email ID or mobile number. If you wish, you may contact here as well. Thank you.